Bandhan Mutual Fund presents MF Corner.
Hello everyone, you're tuned into Mutual Fund Corner YouTube edition, and it's time to understand how you start your mutual fund investment journey, because there's so many options, so many categories, and this can get a little confusing at times. So at this time, it is best to get an expert and answer all your queries and understand what the basics are. Joining me today is Amol, Joshi, founder of PlanRupee Investment Services, with his take and with his expert advice, which is very helpful always. Amol, thank you so much for joining us. And to the basic question, how can one start their mutual fund investment journey? Is it very easy, or it could be a little tricky?
Right. So very important question. As we have been reading in media and everywhere else on social media as well, there are actually lakhs and lakhs, if not crores of new crop of investors that are joining the capital markets. Some of them are joining via stocks and shares route, because now it's very easy to invest in stocks via apps. But all of those people or investors, fresh investors, are also wanting to explore this mutual fund, especially via SIPs, with the kind of awareness that industry has generated. So there are two ways in which you can look at it. You are somebody who is tech savvy, then you especially have to start with your KYC. Unless the KYC piece is taken care of, you cannot really invest in mutual funds. So you can do your, if you have help, if you're investing via your friendly neighborhood distributor, then you can probably do it via hard copy. If not, distributors as well as DII investors too can get online KYC facility via various platforms or asset management companies as well. So if you have some help at your hand, the journey could be very, very easy. If you are DIY, you will have to jump through certain hoops. You will have to, if you want to start SIP, you will have to get your bank mandate in place. So that requires some kind of interface with your net banking or via your debit card and PIN. But yes, once you start this journey, and especially if you stay for longer term, the journey is going to be rewarding. So even if it is slightly tricky, go for it is my suggestion.
And that's why we have experts like yourself to help people navigate through that. What are some of the risks that would be associated with mutual fund investing that that the investor should know about? And is there a particular category they should start with, or it's best to leave it to the expert?
Right. So if you just want to kind of start your investment journey and you are not an aware person, you don't know how the markets operate, you don't know what is debt, what is equity, you don't know asset allocation, then I strongly suggest you start with some help. There are two ways in which you can do it. You can go to a registered investment advisor, RIA, SEBI registered entities or individuals. Pay fees to them basis what you actually want to achieve from your mutual fund portfolio and start the journey. Or if you are not really keen on that, or if your corpus is smaller or for any reason, you can also go to mutual fund distributor entity. Now, these experts will kind of help you start with your mutual fund journey. But I want to come to the crux of your question. That is, what are the risks associated with mutual funds? Now, mutual fund is one of the industries or products that upfront tells you about the risk. So every advertisement that you see on digital media, it always ends with past performance is not a guarantee of future returns, or mutual funds are subject to market risks. So market risk is associated. So in very simple terms, if you're a newbie listening to this episode, in very simple terms, mutual funds are not guaranteed products. So there are various types of mutual fund schemes. There are equity funds that are linked with equity market related volatility. There are debt funds, fixed income funds that will have impact of rising or falling interest rate environment on them. There are commodity or gold mutual funds. If the gold rate falls, you'll obviously see depression in your gold mutual fund NAV. And then there are international equity funds. So mutual fund basically for all the asset classes, irrespective of which asset class do you participate in, mutual fund NAVs, that is your portfolio, it's subject to market volatility. That's certainly some of the risks that you should be mindful of. If you already know, then start your DIY journey. If you do not, then take the help as we discussed in the earlier point.
Okay, all right. So we spoke about some of the risks which are associated with mutual fund investing. Can you leave us with some of the things that investors should do, apart from, of course, going to an expert? Could it be asset allocation or the other things? And what are some of the mistakes that you should avoid? This is a no-no, like no-brainer, you should not do it.
Right. So let me start with mistakes first, and then we can end on a good note as to what to do, what you should do. So one mistake, if you ask me to point, Sonal, that mistake would be extrapolating past returns into the future. So if your friend's portfolio has done 60 or 80% over last 1 year, maybe your friend is great stock picker or mutual fund scheme picker, but larger credit, in my opinion, probably belongs to the market, because market has really done well over last 1 year, last 3 years, last 4 years. So past returns, replicating them in future on a straight line basis is probably the biggest mistake that you can make, and you should really avoid that. What you should do, as you rightly mentioned, asset allocation is certainly one of the biggest portfolio building points that you should not forget. Asset allocation simply means all the assets do not rise or fall at the same rate at the same time. So if you invest in multiple assets, your portfolio will be saved from bigger drawdowns. So asset allocation is something that is very, very important. If you are investing into equity funds, you should invest essentially with long-term investment horizon in mind. Now, what is long-term? It differs. It differs on your starting valuations. It differs on what financial goal that you're investing for. But suffice to say, 5 to 7 years or that kind of, or longer, this is the kind of investment horizon that you should have. Only then invest or choose to go with equity mutual funds. Equity, be it stocks and shares or equity mutual funds, these are not get rich quick schemes. You will have to stay invested, go through the market volatility, try to invest when the markets are down, and then eventually benefit from the spurt that market will show you in phases like the one that we are seeing now.
Okay, all right. As you said, it's not a scheme to make you rich quickly. There has to be a lot of patience, which I think is something very important to point out, because you've seen massive returns, at least in the equity markets in the last couple of years, and it's not a surety that would continue at the same pace. So you've got to be patient to see that compounded annual growth. Thank you, Amol, for joining us today and breaking the basics down for us in simpler terms. We'll speak to you very soon again.
Happy to be the part of the show. Thank you, Sonal.
Okay, all right. With that, we'll take your leave on this edition of Mutual Fund Corner YouTube edition. Stay tuned for more news and updates.
Bandhan Mutual Fund presents MF Corner.